evening, traders from across the globe, and welcome to the 1364th edition of Short-Term Trading Live with Oscar Carboni, and that would be me. Good evening, traders. Tonight's video in these volatile times is coming to you on a Sunday night for trading Sunday through Monday, August 31st, 2015. As we know, before we get into what's on the board, futures trading is extremely risky, causes substantial financial loss. Listen, do not trade. Let me just say it like this. Do not trade if you're a widow, an orphan, those with pacemakers, small accounts, those that are faint of the heart. Anyone that fits on this list, you can think of a lot of other reasons to not trade. Don't trade. Volatility is through the roof. Putting these stops in today, you've got to put a stop in so big that, God forbid, it gets hit. You're knocked out of 5 or 6 winning trades all at once. But if you don't put a big enough stop in, you'll be hit before the turn comes. What to do? If you have a small account, sidestep the volatility. You will not be able to afford it. All right, traders, so what are we going to talk about this evening? I have something interesting to bring. It's basically volatility we know is through the roof. You've heard me speak about Dodd-Frank and how it's taking the liquidity out of our markets, has removed the market makers, the core mechanism that stops the market from dumping like a vacuum. All right, so you know my take on that. I would like to bring you back to my thesis, if you will, which I have many, many videos throughout 2008 and 2009 and many hours logged in my chat room where I had an absolute thesis or theory on what was going on with our markets in 2008 and 2009. And to simplify that theory to the best of my ability, let me show you what I mean. Back in 1971, Richard Nixon was wise enough to recognize that if we did not take this country off the gold standard, there'd be wars with every country. There is no way we're going to have enough gold to back all the money that's being created around the world, in the U.S. No way, if you look forward, are we going to have enough gold. Let's move off the gold standard. So we all know that that happened, right? My thesis has always been, since the day we left the gold standard, they were supposed to start printing dollars, which they have not or did not do from the 70s all the way through the crash of 2008. And that was what destroyed or put a monkey wrench in our economic mechanism. That sounds crazy, I know. But I've been saying this since 2008, since before the crash was done, and once the rebound started, and once the Fed started printing money. And let me see if I can explain with a visual. So follow me, if you will. My thesis or theory has always been this. Up until 1971, you had gold backing dollars, dollars backed credit, which are bonds, mortgages, derivatives, you name it. Credit got backed by dollars, and we backed dollars with gold. What did you do? Every time you issued more credit, you needed a dollar more, you mined a dollar's worth of gold and put it in a vault. The system seemed to work. The scale stayed balanced. Issue credit, print dollars, get gold. Everything seems to work. Okay, so we know that that's how the system works. Richard Nixon came around and he said, no, we can't afford to keep getting gold. It'll never happen. There won't be enough gold in the world. So what I want you to do is, on this side of the scale, I want you to put those dollars. Put them right here. And on this side of the scale, we are going to absolutely unequivocally remove the dollars, and we are going to put on this side of the scale credit. So all the bonds, the mortgages, all that stuff that we were backing by dollars still gets backed by dollars, right? But the difference is dollars back to credit, nothing else backs the dollars. All right, that's our new standard, right? Dollars back to credit. It doesn't need gold anymore, so dollars back credit. Mortgages, derivatives, you name it, they're all covered by the US dollar. Here's where we ran into trouble. When things work normally, if you needed gold, you mined more gold, you put the gold over here like I showed you earlier, and you had dollars over there. Well, if you move dollars over here and you issue more credit, what are you supposed to do when you issue more of this? You're supposed to print more dollars. Every time you issue more credit, you print more dollars, so that it's the exact same system that we had when it was gold and dollars backing credit. What they forgot to do was continue to print these things during the 70s, 80s, 90s, all the way until now, which brings me to something interesting. It brings me to today. This has been my theory ever since 2008. You can ask the OMNIacs who have been around me. I've done videos, countless videos about this. I happen to know that that's one of the major things that went wrong, because as soon as the Fed started printing, our system immediately started correcting itself. So let's get past that. That brings me to today. Creating dollars, printing dollars, doesn't that create inflation? Isn't that what we always knew? Well, that's why they didn't print them. Fear of creating inflation. Now that they're printing dollars, they haven't printed since 71 really aggressively. Do the math. They can print for the next 25, 30 years and still not have printed enough. So printing dollars today in 2015 is not going to create inflation for a long time. That brings me to something very interesting in an article that I want to show you. Traders, this weekend's Wall Street Journal, right? Here's something I've been telling my OMNIacs for quite some time, and this is it. There is no way on earth in today's world, the new market, the new economy that started in 2009, in today's new economy, there is no way the Fed can raise rates based on a 2% inflation target, because crude is cheaper, commodities are cheaper, there's more dollars in the world. It is not the same world it was before 2009 economically, but the Fed gave us a target. We cannot raise rates till we see 2% inflation. Now, I have been listening to the Fed very, very intently since I am 19 years old. My 18th to 19th year I didn't recognize. From 19 forward, I listened very intently. I have learned how to listen to the Fed, and you guys know, because I have brought you many expectations that I thought the Fed would do based on their speak and me listening clearly. I've been able to keep my OMNIacs basically in tune with what the expectations are from us that the Fed will do, and we've been relatively right, so let's move forward with that. The Fed cannot raise rates because they told us they wouldn't raise rates. And bravo to the Fed, by the way, for being so crystal clear about their actions moving forward. Because I heard them, and I've said this to you many times, the Fed said they will not raise rates unless we get a 2% inflation target. They started with the unemployment target. When we got close, they realized that wasn't enough time. They abandoned the unemployment target, went to the 2% inflation rate target before they raised rates, the Fed. I have stated that the Fed is absolutely incorrect. We can never get the 2% inflation the way things are going. They need to abandon the 2% inflation target so they can raise rates. The Fed is ready to raise rates. They just put their foot in their mouths when they told us not until 2%. So my take is that they are going to abandon the 2% inflation the inflation trigger. And here's what I found in that Wall Street Journal this weekend. This is step one, I kid you not. This is step one, the first step in moving forward and finally raising interest rates here in the United States. And this is what I want you to look at. Can you see? Can you read this right here? Very, very interesting. All right, so central bankers re-examine their views on inflation, and guess what you're going to find? From this point forward, our central bankers are going to say, you know what? The way we've been viewing inflation is incorrect. That target we gave you at 2% is incorrect. We are going to change targets to something different. That's the key to getting ready to raise rates. When you hear them say, we're abandoning the 2% inflation target, get ready for the rate rise. That's what comes next. I listen to the Fed very closely, and I know how to read. I know how to decipher what's in these newspapers. I kid you not. This very, very, very interesting, bodes very well with my theories. So, now let's go to technical analysis, because that's all that really matters here anyway. Come on down to livewithoscar.com. Join me in my free chat room. Come join my premium membership if you like. If you like the trades Omni gives us, that's Oscar's Market Navigational Indicator. I offer those trades to you in the form of flash updates 24 hours a day. Just come on down to livewithoscar.com and join the Platinum membership. Traders, let me show you a couple of charts. Volatility is through the roof. Let me show you why. With no further ado, let's go look at some charts. Traders, the NASDAQ daily bar chart. Volatility has skyrocketed ever since we took out a very meaningful support line. See the gray line? Very meaningful support. Once we took it out, the average bar has become a bar this big. This is ridiculous. I mean, the volatility's through the roof. Now, what could be building right here is a little bull flag, so you never know. We might get some upside here. I think we've had enough downside. I think we can start to recover. At least the Omni thinks you can buy dips. I'm afraid we'll play it hour by hour, but Omni says buy dips. E-mini S&P, same sort of thing. Once you broke a very, very major support line, the market went into a tailspin. These days are massive, but you've had a bunch of down days. 1, 2, 3, 4. Then you finally had an up day, second up day. I think 4 down days is enough because they were so massive to get some buying to come back in. So the Omni has started to turn bullish, and hopefully it'll continue on the upside like it's been doing the last couple of days. Then there's gold. Interesting, gold. Omni has been a seller of gold for a long time. The last couple of days it decided to... Well, it sold gold on Thursday, did well, sold gold on Friday, and almost got stopped out. It ended up paying for the gold on Friday. At the same time, Omni has flipped to bullish in gold, and look at this very interesting average I found. Basically, you can't get above it. Even if you do, it's short-lived. You can't get above it, can't get above it, can't get above it. And the only time you did it was short-lived. Well, this time you got above, tested it, rallied up, came back down. I call this a test right here, and it held and went up for 2 days, right? Day 2, day 1. Hey, why not? Omni's getting bullish. I say as much as I'd like to be on the sell side of gold, my opinion is worthless when it comes to the Omni. I put the Omni's opinion out because if I gave you my opinion, I would have lost all of my followers in 2006 when I started these videos. Thank the Lord I know better, and I only give you the Omni analysis. So we're going to be buying dips in gold for trading on Sunday night through Monday. Traders, come on down to livewithoscar.com, and we'll share these charts and get through these rough and tumble markets together. So traders, there you have it. Remember, volatility is through the roof. If you fit in this category, sidestep yourself for a little while. There's nothing wrong with being a bystander while this volatility is going crazy. Do you know how many people will never trade again after the carnage we've seen in these last 5-6 days? Take your time if you're not a pro at this, if you don't have risk capital. You know what I mean? Don't go crazy. These markets will be here next week and the week after when they calm down a little bit. For now, volatility is through the roof. Make sure your stops are wide. And don't forget, that is my thesis. I didn't make it up today. I was saying it long before they started printing dollars. Ask anybody out there. So maybe that is what broke our system. But printing dollars now is not going to create inflation if we haven't printed them, enough of them for 30 some odd 40 years. There's no way we're printing them for the last 5 or 6 years, 10 years even is going to be enough. So if that's not going to create inflation, their target, the Fed's target, is incorrect. They'll never be able to raise rates at 2%. They absolutely want to raise them by December's meeting. The only way to get there is to change targets. That's my next call. Fed changes targets. All right, traders, I'll see you all at livewithoscar.com. The Omni, hour by hour, baby. We're starting off buying dips. I am not being held to anything in this environment. So you come on down to livewithoscar.com, hang out in the chat room. We'll buy when we should. We'll sell when we should. We'll cover and do nothing when we should. All right, traders. Keep your emotions out of trading. One of the best things you can do with helping yourselves, keeping these emotions at bay. I know it is not easy. Put your stops in. Put them in first. Then say this to yourselves every morning, every afternoon, every evening. And you know what that is. Stops are in. Emotions are out. Rock and roll, traders. I'll see you all at livewithoscar.com. Futures trading is risky and can cause substantial financial loss. We do not claim or guarantee that you will profit from the information provided.